The 4% rule is dead. For decades, that was the gold standard for retirement planning. Financial planners built entire strategies around it. Retirement calculators had baked it in as the default. It was the #1 rule that everyone used. But not anymore. Suze Orman recently came out and said that the 4% rule no longer works. Morningstar lowered their recommended safe withdrawal rate, while Vanguard published a paper outlining a few flaws with the 4% rule, saying that investors should not rely on it as it is. In fact, even the guy who invented the rule said that it no longer works for today's retirees. That's why today I'm going to break down why the world's most popular retirement rule no longer works, what the new numbers actually look like, and what does all this mean for you and your portfolio. But first, what even is the 4% rule? Can it one? So the 4% rule was created in 1994 by a financial planner named William Benjamin. He looked at US stocks and bonds going all the way back to the 1920s, and he found that if you withdrew 4% of your portfolio every year, adjusting for inflation, your money would last for at least 30 years. That's because this rule was tested across every 30-year retirement window in US history. And during this period, there were 2 world wars, the Great Depression, the stagflation of the 1970s, multiple crashes. And what this shows is that even if you retire at the absolute worst time in American history, the 4% rule would still survive. And from there, the rule becomes simple. Save 25 times of your annual expenses, withdraw 4% per year, and your money should last you through your retirement. So for example, if you plan to spend $4,000 a month during retirement, that's $48,000 a year, multiplied by 25, and you need $1.2 million. So simple. This means even for the cash that you are holding right now, it should be working hard for you. And one place that you can park it in is money market funds. And right now, Longbridge is running an amazing campaign for new users. You can get a 5% interest booster for an entire year on $2,000 placed in the Cash Plus Money Market Fund. This is a fantastic opportunity, especially since money market funds offer decent returns while being relatively low risk and liquid. On top of that, if you meet their holding and trading requirements, you can earn rewards in the form of Nvidia and Apple shares worth up to $1,150. One of the main reasons I like Longbridge is their zero commission fees and platform fee coupons for the Singapore, Hong Kong, and the US markets. This really helps to keep long-term costs down, which is super important, especially when you are just starting out. And because it is Chinese New Year, there's a sure win prize worth up to $888. All you need to do is open a Longbridge account during this promotional period. No minimum deposit is required. Check out the details and my exclusive link in the description below. But then, here's a problem. Morningstar ran their own analysis and found that the safe withdrawal rate should be closer to 3.7% and not 4%. Why? That's because Benjamin's study was based on US market data from 1926 to 1992. During that period, stocks averaged about 10% a year and bonds averaged around 5%. However, today, the market looks very different. Stock valuations are significantly higher and bond yields are much lower, which means we are unlikely to see the same kind of returns that made the 4% rule work in the first place. Meanwhile, Suze Orman goes even further, where instead of 3.7%, she recommends 3.5%. Her argument is that inflation is like nom nom nom, eating away at retirees' portfolio faster than the rule accounts for. That's because things like healthcare, housing, and food are all rising faster than what the headline inflation suggests. Plus, we are also living longer, which means our money may need to last well beyond just the 30 years. Likewise, Vanguard's paper also showed that the 4% rule only gives you an 82% chance of success over 30 years. But what if you live longer or retire early? In that case, the success rate will drop all the way down to 36%. But here's the biggest problem. The 4% rule was only ever tested on US data, and the US is actually an outlier. In 2010, a researcher named Wade Pfau published a paper with an ominous title, The Demise of the 4% Rule. In this study, he took the same test Benjamin ran for the US and applied it to 20 developed countries. Then he gave each country the best possible advantage, the perfect asset allocation with hindsight, aka whatever mix of local stocks and local bonds would have produced the highest safe withdrawal rates for that country. But guess what? Even with that advantage, the 4% rule only survived in 5 out of 20 countries. For example, he found that the UK optimal withdrawal rate is 3.36%. So if you tried the 4% rule there, you would have had a 24% chance of failure. Germany, 1% withdrawal rate, and over 56% of the time, the 4% rule would have wiped you out. Japan, 37.8% failure rate, and Italy was the most jialat of them all, where it has a whopping 80.5% failure rate. Basically, if you tried the 4% rule there, you would GG Pro Max. Now, Singapore wasn't one of the 20 countries in the study, but all of these countries are large, developed economies with deep capital markets and decades of data. Meanwhile, Singapore is a small open economy with a much shorter market history and a heavily concentrated stock exchange. This means that if the 4% rule couldn't even survive in those countries, the chance of it working here would be less optimistic as well. And this is quite concerning because according to the data, Singaporean investors have a massive home bias. On average, 39% of their portfolio is in Singapore stocks, even though Singapore makes up just 0.4% of the global stock market. Now, I know what some of you are thinking, but I don't just invest in Singapore, I also got diversified globally. Okay, fair enough. In that case, Fao also tested a world portfolio, and the result is still only had a safe withdrawal rate of 3.45%. Meanwhile, the 4% rule still had a 14.9% failure rate. That means that if you were perfectly diversified across every major stock market in the world, you will still have roughly a 1 in 7 chance of running out of money. Even Ben Felix, one of the most data-driven finance creators out there, mentions that when you use international market returns instead of just US data, when you factor in today's market valuations, the safe rate for early retirees is closer to 2%. But then some people might also say, but I also invest in dividend stocks. So if I live off the dividends and never touch my capital, this means I will never run out of money. Well, here's the thing. Since the STI ETF launched in 2002, it has returned about 8% annualized. Meanwhile, the S&P 500 returned about 10%. While this gap might not sound like much, but compounded over a 30-year retirement period, it is the difference between your money lasting and your money running out. Besides that, the idea that dividends are free income is actually an illusion. When a company pays you a $1 dividend, the stock drops by exactly $1 on the ex-dividend date. This means that there's no difference between receiving a $1 dividend and selling $1 of your share. So while it feels like you're not touching your capital, the reality is that you are. Not just that, chasing dividend stocks can actually concentrate your risk. You end up overweight in Singapore banks and REITs, exposed to interest rate risk, property cycles, and even geographic concentration. And on top of that, a dividend income strategy has been found to consistently underperform a total return approach over the long term, even when dividends are accounted for. But wait, that's not all. There's also one thing that the 4% rule doesn't account for, which is the sequence of returns risk. Charles Schwab has a great example of this. Here, we have two retirees, both with the same $1 million portfolio, same average returns. But one gets hit with a 15% drop in the first 2 years, while the other gets hit mid-retirement. They end up with the same total losses. But the one who got hit early would run out of money during retirement, while the other still had hundreds of thousands of dollars left. In fact, research from Fao shows that the returns that you get in just the first 10 years of retirement explain 77% of your final outcome. Now, at this point, you might be thinking, if the 4% rule doesn't work everywhere, and it probably doesn't work here either, then how? Thankfully, here's what none of these international studies accounts for. CPF Life. Now, before you think I'm about to do a CPF Life advertisement, don't worry, I'm not. But the reality is that CPF Life is basically Singapore's version of Social Security, where once you turn 65, it gives you a guaranteed income stream for life. And it changes the math in two huge ways. First, longevity hedge. The biggest fear with the 4% rule is that you run out of money before you pass away. CPF Life eliminates that fear for your baseline expenses. So even if the full retirement sum, you are looking at roughly $1,700 a month. That is actually enough to cover most of your basic living expenses for life, no matter how long you live. Second, and this is the part that most people miss, it protects you against sequence of returns risk. Because CPF Life pays you a consistent amount every month regardless of what the market is doing, you don't have to sell your investments when prices are down. That means your portfolio gets time to recover instead of being drained at the worst possible moment. But of course, CPF Life isn't bulletproof either. Under the standard and basic plan, it pays a flat nominal amount, meaning it is not adjusted for inflation. So as time goes by, your purchasing power gets lower and lower. So for example, at age 65, if your payout is $1,750 a month, assuming a 2% inflation, by the time you turn 85, the payout would be worth closer to $1,200. that's a 31% decline in purchasing power. And that's assuming just a 2% inflation. But in reality, I know lah, the things that actually matter most during retirement can rise much faster than that. For example, back in 2023, food inflation reached as high as 8.1%. Healthcare inflation is currently around 3 to 4%. And while utilities inflation is currently negative, it can spike up to 10% more when times are bad. That's why individually, neither the 4% rule nor the CPF Life is perfect. But when you combine them, they actually cover each other's weaknesses. Here's the same Charles Schwab example that we saw earlier. Both retirees start with $1 million, draw 5% a year while adjusting for inflation. You can see that when the early crash hits, investor one's portfolio gets drained to zero. But now, toggle on CPF Life and think the difference is dramatic. Because CPF Life is covering the basic expenses during the crash years, the portfolio isn't being drained as fast. It has time to recover instead of being wiped out at the worst possible moment. At the same time, because your portfolio is still invested and growing, it offsets the loss of purchasing power from CPF Life. Together, they give you both stability and growth. But with that settled, there's actually another problem that no one talks about. We spend so much time worrying about running out of money that we forget the statistically far more likely outcome. And that is, most retirees using the 4% rule could actually end up with 2 to 4 times their starting portfolio after 30 years. Basically, they die with more money than they ever spent. Now, don't get me wrong, that is a good problem to have, and it's always better to have too much money than too little. But it also means that you could be grinding away for years longer than you actually need to, while missing out spending time with your family, your health, your best years, just to build a safety margin that you'll probably never touch. And here's the other thing, retirees don't actually spend the same amounts every year. JP Morgan tracked real spending data from millions of Chase accounts and found that as retirees age, their overall spending goes down. The only exception here is healthcare, which increases a little over time. But everything else, such as travel, food, transport, clothing, all goes down as you age. This is the problem with following the 4% rule blindly. It treats every year of retirement the same. But the truth is that your lifestyle in your 60s and your 80s are completely different. Because of this, you end up being too conservative in the years that you should actually be spending and withdrawing more than you need in the years that you will naturally be slowing down. And this is again where CPF Life gives Singaporeans a real advantage. Your basic expenses, your utilities, your groceries, your hawker meals, those are covered by CPF Life every single month, no matter what the market does. The floor gives you the permission to actually spend from your portfolio in your early years without the fear of going to zero. So the question isn't just, will I run out of money? It's also, how do I make sure I actually enjoy the money while I'm still healthy enough to? Which brings us back to the original question. If the 4% rule is broken, what rule should you actually use instead? The answer is something called the Guardrails Approach. Here's how it works. You start with a base withdrawal rate. Because you have CPF Life covering your essentials, your starting rate can actually be higher than the traditional 4%, say 4.5 to 5.5%. Then you set two guardrails, an upper rail and a lower rail. If your portfolio drops significantly in a given year, you cut your discretionary spending by 5 to 10%. Eat at the hawker center more, skip the Japan trip this year. But if your portfolio goes up, you give yourself permission to spend a bit more, capped at about 10% above your initial rate. That way, you are not sitting on a growing pile of money that you never used. You just check in once a year, see where your portfolio stands, adjust your spending, and go and enjoy your life. And if you think about it, this is probably what you will naturally do anyway. If the market crashes, you are not going to book a first-class trip to Europe. And if things are going well, you are going to treat yourself a little. Okay, let's sum this up. The 4% rule was built for America 30 years ago. It failed in most of the developed world, and Singapore was never even tested. This means we have actually been adopting a rule that was never meant for us, from a country that turned out to be one of the lucky ones. But with CPF Life and a flexible spending plan, you might actually be in a better position than you might think. CPF Life gives you a guaranteed floor. The Guardrails Approach lets you spend more when times are good and cut back when they are not. In short, the goal of retirement was never to die with the most money. It's simply to live well without the fear of running out. And now you have a system to do exactly that. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every week.